It began quietly in the gray chill of an early winter morning in Washington. Across the Potomac, the city stirred under the muted hum of anticipation, the kind that precedes historic announcements. For months, global markets had watched uneasily as tensions between the United States and China simmered at dangerous levels. Tariffs had been weaponized, technology bans had hardened, and diplomatic rhetoric had escalated to a point unseen since the height of the Cold War. Yet behind closed doors, the tone was beginning to change. In both capitals, the realization had dawned that confrontation could no longer sustain itself. The cost of continued hostility was becoming intolerable, not only in dollars and yuan, but in trust, stability, and global confidence. Supply chains were fracturing, corporations were hesitating to invest, farmers across the American Midwest and manufacturers deep in China's industrial belt were feeling the chill of a divided world. Something had to give. Negotiations had been discreetly reignited months earlier through back channels once thought frozen. A select group of trade envoys, economists, and policy architects from both nations began to outline a path, no toward full reconciliation, but toward a framework, a skeletal, flexible architecture upon which a lasting trade accord could be constructed. It would not solve every dispute, but it would stop the bleeding, restore predictability, and offer hope that the world's two largest economies could coexist under a set of mutually agreed rules. The meeting stretched across time zones, from Washington's stately offices to Beijing's heavily guarded conference halls. Every paragraph of draft text was scrutinized, every word carried weight. Intellectual property rights, market access, energy imports, and data security all lay entangled within the delicate web of competing national interests. Yet, as weeks passed, a rhythm formed. Both sides began to realize that what was at stake was not just trade, but the very architecture of globalization itself. Then came the breakthrough. A compromise on agricultural exports unlocked progress on technology sharing. A side memorandum on digital trade opened the door to tariff rollback discussions. The term framework appeared for the first time in a revised document, deliberately vague but intentionally hopeful. It signaled structure without rigidity, ambition without confrontation. By late autumn, rumors swirled through diplomatic circles that the two powers were nearing an understanding. The global press speculated endlessly, but no one knew the true extent of what had been agreed until the early morning of December 12th. From Washington and Beijing, synchronized statements emerged within minutes of each other. The United States and China had reached a framework agreement for a comprehensive trade deal. The tone was cautious, the language measured, but the symbolism unmistakable. Stock markets surged, oil prices stabilized, and the world exhaled in cautious relief. Yet behind the public optimism, both governments knew the framework was only the beginning. What lay ahead was far more complex. Implementation, verification, political backlash, and the constant shadow of mistrust. Long before the public announcement, the groundwork for the trade framework was laid in silence. The story began not in grand halls or press conferences, but in private rooms, hidden behind the noise of official diplomacy. It started with a call, discreet, unrecorded, and unauthorized, between two senior officials who had once faced each other across tense negotiation tables. The message was simple. Both sides were bleeding, and neither could afford to continue the fight. The first informal meetings were arranged through neutral intermediaries, former ambassadors, trade consultants, and think tank veterans who understood the art of plausible deniability. Geneva, Singapore, and Vienna were among the chosen cities. Each provided a layer of anonymity, a neutral ground, far from the scrutiny of national media. The American delegation traveled under the guise of economic research, while the Chinese representatives were officially listed as investment liaisons. Every movement was coordinated to avoid public detection. Inside these quiet rooms, the atmosphere was fragile. The initial sessions were not about drafting clauses, setting tariffs, but about reestablishing trust that had been shattered by years of mutual suspicion. The negotiators spoke in cautious terms, using broad phrases like strategic normalization and pathway to stability. Both sides were wary of deception. For every gesture of compromise, there was an equal measure of doubt. Yet the economic reality on both sides of the Pacific was beginning to outweigh pride. In the United States, inflationary pressure and agricultural discontent were eroding political capital. The administration faced growing criticism from exporters and consumers alike. Meanwhile, China's manufacturing sector was slowing its currency under pressure, and its global investment footprint strained by uncertainty. Neither side could afford the luxury of ideological stubbornness. The first tangible progress came when both delegations agreed to define a single guiding principle: mutual predictability. This would become the cornerstone of the framework that would later emerge. The phrase implied more than just stability in tariffs. It promised a structured mechanism for communication, crises management, and dispute resolution, a kind of safety valve against future escalation. Weeks turned into months as the informal discussions evolved into structured meetings. A secure digital channel was established between Washington and Beijing, codenamed Mercury Line, to exchange draft papers and annotated notes. Each side employed teams of legal scholars, economists, and intelligence analysts to examine every sentence for hidden risks. Even the formatting of documents became a subtle battleground. A misplaced word could carry diplomatic consequences. As negotiations deepened, the outlines of the framework began to emerge. The first pillar would cover tariff normalization, reducing punitive duties on a phased schedule linked to verifiable trade benchmarks. The second would address technology transfers and intellectual property protection, a subject that had poisoned relations for over a decade. The third pillar, quietly the most significant, dealt with data governance, a new frontier where economic power met national security. At this stage, the process remained hidden from both governments' wider bureaucracies. In Washington, only a handful of senior advisors and National Security Council members were aware of the back channel. In Beijing, the discussions were monitored by a small working group under the State Council's Foreign Affairs Office. Both leaderships had learned the lessons of previous failed negotiations. The more people who knew, the higher the risk of political sabotage. Despite the secrecy, whispers began to circulate among intelligence communities and global analysts. The sudden softening of rhetoric in official speeches, the unexpected stability in currency markets, and a unexplained optimism among multinational corporations all hinted at movement beneath the surface. Still, the details remained elusive. The turning point came during a 3-day retreat in Zurich, held under the cover of a global economic symposium. There, away from cameras and press, both delegations met face-to-face in their full capacities for the first time. It was during this meeting that the word framework was first formally proposed. It was a diplomatic invention, deliberately flexible, strategically ambiguous, and politically palatable to both sides. The framework would not require legislative approval, yet it would carry the weight of a binding understanding. For the Americans, it offered a narrative of strength, a demonstration that pressure had produced cooperation. For the Chinese, it preserved sovereignty, proof that negotiation could achieve parity without concession. Both could present it at home as a victory. After Zurich, the back channel became an unofficial institution. Draft versions of the agreement circulated under code names, each revision more detailed than the last. Key global partners, including the European Union, Japan, and ASEAN, were quietly briefed to prepare for the ripple effects. Financial analysts began to speculate about tariff rollback dates, while energy traders recalculated forecasts based on possible changes in export policy. Meanwhile, both capitals prepared for the inevitable moment when secrecy would end. Teams were assembled to manage public perception, coordinate media narratives, and align talking points for the eventual joint announcement. Every word in the official press release would be calibrated for maximum reassurance and minimum controversy. But beneath the calm surface, internal resistance was growing in Washington. Hawkish lawmakers accused the administration of surrendering strategic leverage. In Beijing, nationalist voices warned against perceived Western traps and economic dependency. The framework, even before it was born, faced a storm of suspicion from both shores. Still, the architects of the deal pressed forward. They knew the stakes transcended politics. What they were building was more than a trade accord. It was a fragile bridge between two competing visions of the world. If it held, it could stabilize global markets for a generation. If it collapsed, it could plunge the international system into chaos. By the time the last Zurich draft was approved, the atmosphere among negotiators had shifted from caution to quiet determination. Both sides understood that the next phase, the political unveiling, would be far more perilous than anything that had come before. The secret negotiations had achieved what few believed possible: the outlines of a truce in the economic war between the United States and China. But the real battle, the struggle to make it survive public scrutiny, was only just beginning. The morning of December 12th arrived with a strange calm in both Washington and Beijing. The sky carried the pale gray of approaching winter, a colorless backdrop to a moment that would soon fill headlines around the world. Months of secrecy had led to this single day, a synchronized unveiling of what officials on both sides had cautiously labeled a framework for a comprehensive trade deal. In the U.S. Capitol, the White House press room was unusually still. Reporters, analysts, and camera crews crowded the space, whispering among themselves. Rumors had been swirling for weeks about a major breakthrough in trade talks, but few expected an official statement so soon. Across the Pacific, in Beijing's Diaoyutai State Guest House, a similar gathering took shape, equally choreographed, equally controlled. The dual announcements were scheduled to occur within minutes of each other, each reading from separate but carefully aligned scripts. The statements were brief, measured, and intentionally unspectacular. They spoke of a mutual commitment to economic stability, a pathway to sustainable cooperation, and a framework designed to guide future trade normalization. 7, no numbers, no timelines, no dramatic gestures, yet the effect was immediate. Within seconds of publication, global markets reacted as if a great weight had been lifted. The Dow Jones spiked nearly 500 points in early trading, while Asian exchanges opened to surging optimism. The yuan strengthened modestly and oil prices steadied. The words framework, agreement dominated news broadcasts across continents. Analysts dissected every phrase, comparing the linguistic nuances between the English and Mandarin versions. Commentators noted the cautious tone, neither triumphalist nor apologetic. For the first time in years, both powers appeared to be speaking the same diplomatic language. But beneath the surface of this orchestrated calm, the machinery of statecraft was in full motion. In Washington, the National Economic Council activated a crisis communication unit to coordinate with U.S. allies. The goal was to prevent confusion and ensure that the announcement was perceived as strength, not concession. In Beijing, the Ministry of Commerce issued directives to domestic media, emphasizing the narrative of mutual respect and shared prosperity. State broadcasters replayed carefully edited footage of cargo ships, factories, and bustling trade ports, visual proof that China's economic diplomacy had achieved balance without submission. The world's reaction unfolded in waves. In Europe, officials welcomed the news with restrained optimism. The European Central Bank issued a statement calling it a stabilizing development in uncertain times. In Tokyo and Seoul, markets responded positively but warily. Both governments understood that a thaw between Washington and Beijing could realign regional trade hierarchies overnight. In Southeast Asia, where economies were tightly interwoven with Chinese manufacturing and American finance, relief was palpable. The bar nations caught between the two giants. The framework offered hope that the trade would once again flow without political turbulence. However, not everyone celebrated in Washington. A chorus of skeptics emerged within hours. Lawmakers, especially those aligned with protectionist interests, warned that the agreement lacked enforceability. They argued that the administration had given away leverage for promises that could easily be broken. Cable news channels aired panels of economists and former officials, some praising the pragmatism of de-escalation, others condemning what they called a retreat from hard power. Across the Pacific, similar tensions brewed within Chinese academic circles and policy institutes. Quiet debate erupted over the framework's implications. Some viewed it as a masterstroke, a diplomatic maneuver that would buy time for economic restructuring. Others feared it signaled over-reliance on American markets and potential vulnerability to future pressure. The state maintained a unified message, but beneath that message was unease. By the second day, the geopolitical consequences began to crystallize. The announcement had not only stabilized markets, but had also reshaped the diplomatic chessboard. Nations that had hedged between Washington and Beijing found themselves recalibrating alliances. Energy exporters, sensing renewed demand, reopened supply channels that had been frozen during the tariff wars. Corporate boards convened emergency meetings to assess the new commercial landscape. Even in the financial centers of London, Dubai, and Singapore, the framework became the subject of intense speculation, a potential reset button for global capitalism itself. Behind the scenes, both governments were struggling to maintain the illusion of unity. The negotiators who had labored in secrecy now faced the glare of public scrutiny. Every decision, every phrase of the framework was questioned.